Hi, everybody. Thanks so much for joining this panel on successful models for regulated embedded finance. It's a super timely and important topic. My name is Steve Boms. I'll be moderating. I'm the president and founder of Allon Advocacy, a Washington, D.C.-based fintech consulting firm. And I am joined by three exceptional panelists from multiple markets, multiple perspectives, who can share some of their expertise with us for the next 40 minutes or so. Those panelists are Jeanette, who is the head of compliance and public policy at Gusto. We have Jason Wang, the chief risk officer at Synergy Credit Union in Canada, and Julian Alcazar, senior payment specialist at the Federal Reserve Bank of Kansas City. Thank you all so much for making some time to join this conversation. Julian, maybe we'll start by picking on you as the resident regulator on the panel. When you think about, from the regulatory perspective generally, embedded finance and fintech more broadly, I suppose, what are some of the things that you think about in terms of compliance, customer protection, etc.?
Hi, everyone. Happy to be here among such a esteemed group of panelists. I'll give my general spiel. Statements made today do not generally represent the views of the bank. They represent my own personal views. So we've all heard the notion of software is eating the world. I'm not that clever, and I'll attribute this part to Tim Cheadle from Credit Suisse. Payments is definitely taking a bite. As non-financial institutions, whether that it's a SaaS provider or a marketplace, they're starting to embed some kind of financial service in their products. This presents a unique risk as regulators don't necessarily have a purview into some of these companies. With that said, banks and other financial services companies must be diligent in who they choose to partner with, because at the end of the day, regulators they ultimately come and investigate the bank or the financial services product. And not to be all doom and gloom, I'm excited about fintech. Fintech has pulled the future closer, challenging the status quo, incentivizing better consumer products, and most regulators today actually have some kind of fintech office that regularly engages with traditional financial services firms and fintechs.
Jeanette, I'm curious for your view, different perspective, although you've worn several hats in your career. But from the perspective of a practitioner, somebody who leads the compliance team at a prominent fintech that itself deploys embedded finance tools, how do you view the regulatory challenge of providing those same levels of appropriate customer protection in an environment in which, at least in my view, the market's moving faster than government can keep up?
Yeah, great question. So Gusto is a people platform that serves more than 200,000 small businesses across the country. And we provide a variety of services. Not all of them are kind of financial services or fintech. We provide payroll services, health insurance benefits, 401k tax benefits, lots of other employee management tools. And so it's really interesting being at Gusto, where we are also providing financial services, but not everything that we do is kind of what you might think of as a traditional fintech suite of services. So what we really do is we prioritize compliance for a couple different reasons, both to make sure that we are staying on the right side of our regulatory obligations, but also because we always kind of go back to foundations. Many regulations exist to ensure that consumers are protected and that consumers understand the terms and fees for products that they use. And that's something that is really important to us, to make sure that our customers, both our small businesses and the employees that work for those small businesses, understand the terms of our products, understand what they're getting into. And we believe in transparency and informed choice in all of those products. And that's something that's really foundational to Gusto as a company. And as we think about how to build financial products for those that use our products. Our financial products are unique in that they are embedded in the payroll experience. So I love this panel. I love this whole conference because I think embedded finance is something that we think about all the time. At Gusto, a person can onboard at a small business as a new employee and sign up for health benefits, provide tax withholding information, and sign up for an embedded bank account to automatically set funds from each paycheck all at the same time. And how we think about making sure that we're kind of appropriately balancing consumer protections with regulations is by really working closely with our bank partners and regulators to make sure that they understand how we are thinking about that embedding of information, how we are presenting information to our customers, how it works with the existing platform where some of the services may not be financial services and non-financial products. And then we find that taking a proactive approach with our partners and financial regulators helps us in the long term so that nothing is a surprise. If they come in and do audits or examinations, they've kind of been with us all along the journey and have been aware of how we're choosing to present our information.
Thanks, Jeanette. So this is Embedded Finance North America. And as I said, we're fortunate to have a representative who's on the other side of the border in Canada. So Jason, just to set table stakes, the Canadian and US marketplaces are very different. The regulatory environments are also very different and unique. How are these issues being deployed, but also contemplated in Canada?
Well, the Canadian regulators have a reputation. We all know that the Canadian banking industry is highly regulated. And for the most part, it serves a good purpose. For example, in the most recent global financial crisis that started in 2008, not a single Canadian bank failed for capital reasons. Well, Canadian banks have failed for other reasons, but not for capital. That's because the regulators simply said you need to have this much capital ratio. And the ratio varies for federally regulated banks versus credit unions. And I work for a credit union. We actually have even a higher capital ratio that's required. So you can say the regulation is pretty tight, but at times it does serve a good purpose. Now, coming back to, as a practitioner, how do we work in this highly regulated environment? Based on my experience, I think we've learned maybe two ways to tackle the situation. Advocacy and a voice from the industry is definitely key. The regulators and sometimes the media pay more attention to bad news. And sometimes the media might really magnify the impact of one incident that might be isolated. And whenever there's a privacy breach, for example, data breach or hacker incidents, you see that all over the news. But the root causes might really be different. And these incidents don't always point to something broken in the controls and in the risk management in the organizations. So the voice is definitely important from the industry to let the regulators understand that if an incident is one-off, it may not be truly representative of a systematic issue, and the regulators need to also look at the good things that the financial institutions have done. So that's number one. The second thing I wanted to point out would just be this concept that we call right-sized regulations. So also, it takes us to constantly be talking to our regulators, asking them to pay maybe more attention to principles and intentions and be less prescriptive. Now, in case you didn't know how the Canadian banking industry and what the players are, how the industry is not a level playing field, there's about 270 credit unions. And all of these credit unions combined, the asset size is still a fraction of the asset of the largest bank, the Royal Bank of Canada. And the five major banks dominate more than 80% of the banking business in the country. Now, there are fast rising fintechs also, but still, I think there's maybe some time before we see that they take over the market share. So when it comes to then risk and compliance issues, if I look at one of the five major banks, their risk and compliance team could probably just be bigger than the entire workforce at Synergy team. So if the regulators are equally prescriptive on any particular thing, then the pressure will be unfair and sometimes just unbearable for us. So, our voice has always been that the regulators need to look at what's appropriate for each organization, and maybe just stay on the principle side, stay on intentions, and be less prescriptive.
Jason, that is such an interesting point for this panel. And Julian, I'm going to ask you a question on this, because for all of the uniqueness of both the Canadian and the US market, it strikes me that this is an area where there's actually quite a bit of commonality. Where in the US, certainly you have very large financial institutions, but you have this incredibly long tail of smaller financial institutions and credit unions. I think the last time I looked, there were about 10,000 or so insured financial institutions and credit unions in the US. This concept, Jason, as you said, of the right-sized approach, Julian, I assume that that's one you and your peer regulators contemplate all the time. How do you think about that in the embedded finance and fintech landscape?
Definitely. Yeah, so there is no one-size-fits-all regulation. As it relates to regulators, there is a careful balance that must be achieved. Actions that promote safety and soundness, actions that promote acceptable and manageable level of risk, and most importantly, consumer protection. The Fed has been rather proactive in this arena. Governor Bowman, who was appointed in 2018, is the first person to fill the community bank seat on the board. So she specifically looks at regulation that impacts small financial institutions. The Fed has a community bank supervisory framework to tackle these issues around small financial institutions. How do we right-size things, which includes a bank exam tailored to risk. And because we're government, of course, it's an acronym known as BETTER. The program allows examiners to identify higher and lower activities and in turn streamline the examination process for lower risk community banks, thereby reducing the burden on our small banks.
Thanks, Jason. Thanks, Julian. Jeanette, I wonder if we can go from kind of the general into a little bit more specific. So we've set the table, right? We've generally laid out the current landscape, how we're thinking about these things in a broad sense. But as I said before, you're at the cutting edge at Gusto as a practitioner, a company that's deploying some of these products that we're talking about today more generally. Can you give us some examples or an example of a product or solution that Gusto has launched where there is a balance of customer protection and innovation, but that lives in this somewhat ambiguous regulatory environment where, again, the laws, the statutes, the regs haven't quite caught up precisely to where the market is today?
Yes, I love this question, and I'm so excited to share with you more information about one of Gusto's products, which is called Gusto Cashout. We're really proud to offer Gusto Cashout. It's a financial product that people can use to access cash between paydays. And we use information on our platform about how much an individual has already earned within their pay period, their earned wages, and make those funds available to consumers without any fees or interest. We have found that access to these funds makes consumers less likely to use high-cost loan options like payday loans, paying credit card late fees or overdraft fees. We've also seen research that financial security options like Gusto Cashout reduces employee churn and makes employees more likely to stay working for their for their employer. So we think this product is really an example of an innovative product that has unlocked the paycheck and is a win-win for both the consumers, the employees of the small businesses, as well as the employers to ensure that their paycheck works for them and that they can access funds when they need them. Now, this marketplace is generally known, products like these are known as earned wage access products. There are a lot of companies out there that are offering earned wage access products. Many of them have very different models. Some of them involve the employer, some of them do not. Many of them have fees that may not be transparent to the consumer, or they may kind of require repayment at different times. But Gusto actually, kind of getting back to your original question, which is how has Gusto balanced the kind of innovation with the regulatory environment? Gusto basically took a look at the landscape and decided to actually take a really different path than a lot of the other earned wage access providers in this space. Gusto purposely opted to structure Gusto Cashout in such a way that it kind of falls into the traditional regulatory space. We structured our product as a closed-end loan that we offer with a bank partner. So we believe that this makes the product more transparent and understandable to consumers. People tend to know, more about the Truth in Lending Act, about what loan disclosures should look like, and so we provide those disclosures to the consumers. We also put in place guardrails such as limitations of monthly usage, making sure that the consumer only takes out one loan at a time, dollar caps on the amount that a consumer takes out, and again, just to kind of reemphasize, we also are offering this product with no interest and no fees. So we believe that this balances innovation and consumer protection, and also ensures that the regulators understand what we are doing, because we're basically using the existing regulatory framework to apply to a new product, and that we are providing all of the Truth in Lending Act disclosures and those required by traditional lending laws, and then working with our bank partners and regulators so that they understand what we're doing.
That's fantastic, Jeanette. Thanks for sharing the details of that. And I'm so glad that you used an earned wage access example, because Julian, I know this is an area that you personally have spent quite a bit of time, considerable time studying, thinking about, and published a paper about it last year. In your view, what are some of the best practices for a customer protective earned wage access product?
Yeah, thank you for the question, and bravo to Gusto and the consumer-centric approach that you guys have taken around earned wage access. Earned wage access has been around for a little bit, but during the pandemic has become very popular as income has become volatile and emergencies don't necessarily wait for payday, right? So some of the best practices that I've seen out in the market at the moment are those that are embedded with the workplace, because it gives them a clear line of sight into the hours worked by the consumer. Additionally, by having a clear line of sight into the hours worked, they're able to cap the amount of money a consumer is actually able to get. So they'll cap it at 80% of an earned wage for the day. Additionally, another best practice, also stemming from the pandemic, is very minimal fees or no fees. And of course, we have to incentivize good consumer behavior. So rewarding the consumer for doing the right thing at the end of the day. Earned wage access programs, unlike a typical loan, are paid back through an employee's paycheck on payday. And so that's why it's important to cap that earned wage. So the consumer, at the end of the day, when it comes to payday, they still have a little bit of money left over.
Got it. This would be a great time, by the way, if you're listening in or watching and you have a question, to please join the conversation by submitting a question through the platform, and we'll be happy to respond as we have the conversation. I know we're getting into the weeds of some really complex and interesting topics here. So if anything is provoking a thought or a question in your mind, please do join the conversation and chime in. Jason, let me kick it to you. We were talking about this recently. And again, the Canadian and US markets are a bit different. I think we don't have quite the same type of earned wage access tools just yet in Canada, but you have in a prior role a leading Canadian fintech worked in the lending department. And so you have very kind of front row seat experience to this idea of balancing customer protection on the one hand and innovation on the other in a regulatorily ambiguous context. I wonder if you can share some of that experience with us.
Of course. And you're right. The actual phrase earned wage access hasn't been used widely in Canada, but I think it's coming from the same principle, which is responsible lending that we share in many jurisdictions. And this is a concept that might, for the prime and higher income population, might just be a concept. And by default, when you pull up the credit of a loan applicant, then probably the debt service ratio is not an issue. But it's a very important and particularly important issue for the underbanked, subprime, or low income population. So in a way, the protection of this particular segment and making sure that the lenders abide by the responsible lending concept has stimulated innovation in a way. So let me give you an example. For a prime applicant, recall the last time you applied for a credit card on the internet, it's asking for your personal information and asking for your consent to pull your credit. Of course, that's a must. And then it's asking some basic information about your annual income, maybe your housing status. Do you own or do you rent? If you own, what's your monthly mortgage amount? If you rent, what's your monthly rent? And that's probably about it. And you probably won't get a phone call asking you to verify the figure that you put in as your annual income. But it's a very different process for the subprime population, because this is where they could get into a high debt ratio situation. So as a responsible lender, then when we make the decision on the loan, the math needs to be a lot more precise. But then how do you do it in a reasonable time frame? And probably you want a good customer experience, probably as good as the prime segment, that you need to return that decision back to them within 60 seconds. So this is where you use an API to connect to their banking. And of course, that's after they give consent for you to do that. And once the banking transactions from the last 90 days, the data comes in, then you will need to use AI and data science to actually determine what's real wage by looking at a pattern, what's not real wage, but a one-off deposit or transfer in, and any habitual spending that might indicate lack of financial disciplines or addictions like excessive alcohol consumption or gambling. And again, we're talking about sometimes relying on the machines to make a decision. So humans need to tell the machines to stay clear of a few very strict lines. So for example, you cannot make a loan decision based off of a few protected classes or a few protected statuses, right? So making decisions based off of income, debt service ratio, and credit, and maybe some other things that reflect character is okay. So this is interesting, and I think there are some solution providers in both the United States and Canada that are helping some fintechs to speed up their innovations in this particular space.
And Jason, I don't want to give people the misconception that just because, for example, earned wage access is not a term that's widely used in Canada, that Canada is completely behind the eight ball. Just recently, for example, there's been movement afoot on open banking. Isn't that right?
Yes. Open banking, it brings back memories. So this is not a new concept for Canada. It has been on the federal government's agenda even before the pandemic. So in 2019, I recall when I went to conferences, and back then it was all in-person conferences. So it seems like such a distant past, but that was just 2 years ago. In 2019, when we went to conferences, open banking was all everyone talked about. And even at that point, it seemed imminent. But then, of course, in the beginning of 2020, COVID-19 hit. So the government had to really focus on fighting the pandemic, which obviously was much higher priority. The topic of open banking has now resurfaced or been renewed by the government. So a few weeks ago, the federal government released the final report indicating an 18-month timeline for the federally regulated banks to participate. So for them, it's mandatory participation. For the provincially regulated financial institutions like credit union, and Synergy Credit Union is provincially regulated, the participation is voluntary. But this is a game where I think if we choose to maybe skip or not participate, then it's only going to make the uneven playing field even more uneven in Canada. So this is early speculation, but I think you would see a lot of credit unions and non-federally regulated institutions wanting to participate and trying to get it done within an 18-month timeline.
So this tees up what I think is going to be my favorite part of this conversation, which is, we've talked about where we are today. Now I'd love to talk about where we wish we were and where we hope to be in a few years. So Jeanette, I'm going to put you on the spot first. I think if there's a theme to this conversation, it's been, we have kind of best practices and thought leadership from practitioners, from a representative of a regulatory institution, who have all staked out what we think are the right ways to approach fintech and embedded finance in regulatorily compliant ways. However, it's still ambiguous, right? And we're still kind of drawing conclusions based on statutes and regulations that really never envisioned the world that we're living in today. And so in some cases, the way that these models or products or solutions are being deployed have a tenuous relationship with the original intent of those statutes or those regulations. So if I could give you a magic wand, Jeanette, and we're having this conversation 5 years or 10 years from now, what are you hoping has changed between this conversation and that conversation 5 or 10 years from now to provide a more tangible, clear guideline for somebody who heads a compliance department at a fintech company that allows you to provide innovative solutions, but also eliminates some of that ambiguity?
Yes, lots of good aspects here to this question. So, I mean, lots of different things I think are possible areas that I would love to see development on in the next 5 to 10 years. I think that, as we kind of evolve in fintech, we're going to see a lot more verticalization of financial services by companies that are not primarily financial services companies. We're also seeing a lot more traditional banks kind of create kind of like banking as a service options so that non-financial companies can get in the game, so to speak, very quickly. Sometimes the big headlines are around companies like Amazon, Google, Facebook that will continue expanding into financial services. I think that, that may happen on the large company side, but I think we'll also see more embedded finance in companies like Gusto, where we're a payroll company, we're a small business platform that provides a whole suite of services. I think we'll see other companies that are kind of, similarly situated to Gusto, where, we may be focusing on other services, but there are options for us to start thinking about how do we provide small business options and consumer financial options within the platforms that we have that may be focused on kind of a broader context than just financial services. So I think it'll be interesting to see how regulators adapt to these business models and create refreshed frameworks about how to think about embedded finance and how to think about what regulatory tools they have to reach companies that may not be kind of their traditional set of regulated institutions. I like that we touched a little bit on kind of the idea of decentralized finance and open banking. I think those are also areas that I'd love to see regulators take on a little bit more directly in terms of what the expectations are and how existing laws and regulations apply to those models, and kind of where there might be gaps or where existing laws and regulations really just kind of won't be able to accommodate some of these new business models. And there may need to be new laws and regulations or kind of revisions of what exists already. I would also hope that we'll see a lot more from regulators about how to think about the use of data by companies. Obviously, this big data is a big question. It's beyond just the financial services space, but there are very real questions here about how to make sure that consumers understand how their data is being used, their financial data in particular. Make sure that they know that, if they do have options to take their data with them to other companies and other options, that they know how to do that and why they would do that. I mean, I think some of the questions right now that are currently debated about kind of like porting data from company to company, I think it's important, but somewhat is still theoretical to a lot of consumers because people don't really understand how to do it or why they would do it. So it seems like there's a little bit more to be done there. There's a lot more to be done there. And how to really change consumer consumer understanding about data and come to view data as an important asset in their lives, our regulatory structure really hasn't kept pace with any of this. I mean, I like to point to the Equal Credit Opportunity Act, which was passed in 1974, as an example of a law that had really good intention, when it was created, and it was intended to respond to the growth of consumer reporting agencies that were kind of doing some early data crunching on people's personal information, right? And so that law was really meant to empower consumers to understand what consumer reporting information was being gathered about them, and to be able to respond and correct data that was incorrect. That was, kind of a good intention law, but it's if you look at it today, it doesn't include any of the activities that are going on by lots of the companies that are using data in non-consumer reportable ways. And so I think that is an example that, I'd love to see the kind of general approach to data be tackled in the next 10 years, and that we find that balance between innovation and consumer protection. I should say also that I think private companies should be thinking about these questions already, and even in the absence of a government mandate. The private sector and the government regulators mutually both have a responsibility to ensure that technology is deployed responsibly, and that we always not lose sight of the individual person that uses financial products. As we in the private sector design products for consumers and for individuals, it's important that we think about, how do we make sure that people understand what they're getting into? And that's something that I think, in the absence of government mandates, that's important for companies to also think about their own responsibilities in the space.
Those are fantastic examples, Jeanette. My favorite anecdote of a law that hasn't really kept pace is FTA and its use of access device, which in the 1970s really meant an ATM card, which we now think of as a debit card, but is really the foundation of how data is shared today electronically. So let me put you on the spot, Jeanette. You've laid out a pretty holistic view of what you hoped we would see 10 years from now. How optimistic are you that we actually get that type of clarity and understanding that you've just laid out?
So I think there is good development. I know that there are tons of regulators that are thinking about these same ideas and questions, right? Like I'm excited that we have here Julian on the panel too, but I know that there are many working groups, there are many people that are thinking about these questions. So it's not something that's the, kind of the purview of just private companies here. But I think that these are hard questions, though. I think the reality of some of the regulatory environment is that there are limits to what regulators can do without an active Congress. And, there has been a longstanding debate in Congress in terms of how to think about data. And, it's hard to kind of separate some of the financial data pieces from the bigger big data questions. And, so I would worry that will create, I think, challenges in thinking about what does an ideal piece of legislation look like. It will kind of start to feel a little bit like, we're trying to attack all the problems at once. Just an example too from, the last, I think 15 years or something, there's been various proposals on uniform nationwide privacy legislation, in Congress, and data breaches and how to create more of a nationwide data breach standard, and that still hasn't been able to be accomplished, right? That kind of happens year after year, and what we've seen is the states all coming out with their own versions of data breach legislation, and more now on the privacy side too. So I think that we'll see a lot more probably on the state level, and I think there's a lot of regulatory interest. I think it will be interesting to see kind of how much regulators could do without an active Congress, and also how congressional leaders kind of act to move on this as well.
Thanks, Jeanette. Jason, I wonder, you gave us the example of the open banking report that's really just fresh out the door, just a couple of weeks old. But I wonder, for your perspective of the same question in the Canadian context, if we're having this conversation 5 or 10 years from now, what are you hoping is different? What are you hoping government or industry or both have done to drive this conversation meaningfully forward?
Other than open banking, probably in 5 to 10 years, I think it will be reality in Canada. Other than this, I think ESG will be the issue. that probably past. A lot of people don't time accepting that this is a real issue, but the train has left the station. So particularly in the Canadian context, knowing that some of our regions are heavily dependent on fossil fuel production, for example, the province of Alberta, then how does the government, how do the governments on different levels, the provincial and the federal level, support these energy companies through the transition? And what role should a financial institution play? Synergy Credit Union does business with some of these energy companies too. And by talking to them, I get the sense that their leadership is not resisting the direction that the whole world is moving. Because we know that you can't fight this, right? So we want to protect the only planet that we can live on for the foreseeable future. Although there's a few pioneers are looking for different alternatives, but the reality is we're going to be living on this planet for the foreseeable future. So whoever you are, even if you are an employee or senior management from the oil company, you still need to protect the planet. They get that. But the biggest wonderment is, other than a blanket and audacious announcement or statement from the governments, and we see that a lot of countries have come forward to say that we pledge to be carbon neutral and net zero by the year 2050. A few countries have said 2060. Whatever the year is, the government needs to do more in terms of figuring out initiatives to support different businesses, more so in the energy sector, to do the transition, and give financial institutions enough support and help and power, and maybe even support from capital to help them through. And this is a concept that we call transition finance that has recently been also a topic where we are. So other than transition finance, then standardizing the reporting on the ESG side, I think will also probably be something that the industry will be calling for. So a lot of businesses, whether a public traded company or a non-listed company, are now looking to include ESG reporting assessment in their annual report, but there's no standard even now. I've recently come across a DEI report from a public traded company that's 80 pages. So 80 pages just on diversity, equity, and inclusion. And their annual report, usually without the DEI part, is only 160 pages. So now they're looking to increase the length of their annual report by 50% just to report you on DEI. Now, I'm not saying that DEI is not important, speaking as a member of the visible minority, but what is the standard, right? You don't want to under-report so that some important issues are not discovered. You don't also want the industry to over-report to create this unnecessary burden on their resources, right? Whether it's the accounting department, HR department, or marketing department. So I think we're looking for the government to give more support and guidance in the ESG space in the next few years.
And let me put you on the spot the same way I put Jeanette on the spot, Jason. How optimistic are you that you'll see the type of progress, both from government and from industry, in 5 or 10 years that you've laid out?
I would say I'm pretty optimistic. The Canadian government has a tradition of looking maybe across the Atlantic and Europe to see what are some of the advances that the European advanced developed economies have done. So they have borrowed a lot of the concept of privacy regulations from the European countries, and they're actually recently are pondering making more moves just to copy more of the GDPR. And when it comes to ESG, Germany and a few other European countries have also recently, as recent as this year, made some important regulations and announcements. So I am confident that there's good examples for the Canadian government to learn from. And also there's lessons learned that they can also look at. For example, open banking in many different countries in the world. And these there's some lessons learned, and they have been included in the consultation in the Canadian government's open banking initiative. So I'm pretty confident and optimistic about the fact that I think the government here will get it done right.
That's excellent. Julian, I'm going to ask you a slightly different iteration of the same question to close us out. You've now heard from two representatives from industry on what their ideal future state would be in this context. Is this an area in which you think regulators and industry would agree? What's your ideal 5-10-year state look like?
Yeah. So again, my personal view, my ideal state is one that's based on respect and trust between regulators and industry. Regulators are often looked at as a black box. We really are not. We're open to dialogue, and we try to facilitate as much dialogue as we can with everyone that we supervise. At the present moment in time, I'm really excited at the type of innovation that is occurring, because it's pushing, as I mentioned earlier, it's pulling the future closer to us by creating a democratization of finance, by allowing consumers that were often invisible and getting them into traditional financial services, understanding that our old credit models don't really work for everyone, getting new data in. And the people that are starting to lead the agencies today are individuals that are very thoughtful, that have studied the industry for a while, that have worked in the industry. So I'm very optimistic for what's to come.
Well, if that isn't as good a way to end this conversation, I'm as positive in it as possible, I don't know what is. Jeanette, Julian, Jason, thank you all so much for your time, for your expertise, for your perspectives. Thanks to everybody who tuned in to listen to the conversation and for your questions. And I hope that you'll stay tuned. There's a ton of additional content coming up. Next up, we have a panel on creating new value models, which should be fascinating. So thanks so much, and we'll see you soon. Take care.
Thank you.